In the second scenario, let's say Apple is going down. So this was the first scenario here. In the second scenario, Apple is going down, it's dropping, but only to $250. It's not dropping all the way down below your strike price. Remember the strike price of 240? So this means now the buyer doesn't get anything because Apple didn't move far enough down. So, and we paid $2.11 for this option for the right to sell it. So we are out of pocket $2.11. The seller, on the other hand, now is happy because the stock stayed above the strike price. So meaning that he collected the premium and doesn't have to give anything back. So he collected $2.11. Pretty good. So again, the 4 building blocks that we have here is, now we were talking about the put buyer. The put buyer right here is happy if the price goes down. The put seller is happy if the price goes up. Making sense? All right. So stop. Again, you gotta understand before we move on, this is your second stopping point. This is where you want to stop and say, okay, did I really get all this? These 4 strategies that we talked about. Because then we're going to talk about more of when exactly you want to be a buyer and a seller. So if right now you're still confused and you have a question and you say, I'm not quite sure if I got it, again, make sure that you print out the presentation that I have for you. Take some notes. Watch this again while you're taking notes. And trust me, after watching this video 2 or 3 times, you will get it. It just, if this is your first exposure to options and you're still a bit confused, it is absolutely normal, but don't worry about it. I promise, if you watch this 2 or 3 more times, you will get it. Okay, but don't move any further if you're confused already.